Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Hello and welcome back to the Weekly Trend podcast. Today is January 6th, 2023. S&P currently sitting at 3868. Hope you all enjoyed the holiday break. This is our first podcast in a few weeks outside of the ETF episode that we released last week, a little bit of a special edition. While everyone was enjoying the New Year lulls. And today I'm joined by one of our analysts, Kevin Ferrari. So, Kevin, is there anything that you want to start us off with? Anything from 2022 or anything you've noticed to start the new year this year in 2023 so far? Granted, we're only a few days in.
Yeah. But I mean, if you start there with 2023, I guess there's really nowhere I necessarily want to start because nowhere is about all we've done or gone.
I agree. I mean, you go back to really even before Christmas, mid-December, around the 16th until still today, we have basically traded in a 3% range.
Mm-hmm.
And those, for the most part, have been 1 to 2 day moves in each direction. 3% to the upside, 3% to the downside, vice versa. Yeah, for basically 3 weeks at this point. So definitely not our cup of tea, right? We're, for the most part, want to get involved in trends, things that are going up, things that are going down.
Just going somewhere would be nice, yeah.
Yeah, and with the major indices basically sitting flat, there has been not a lot of action. Of course, a few things here and there, like there have, indices were down in 2022, but here and there are things working. But as far as the what is the market doing? Been kind of sideways. In fact, no, not kind of sideways. It's been very sideways.
Yeah, about as sideways as I think you can get, right?
Yeah, commodities not doing a ton either. They've kind of been back and forth. When you pull up a weekly chart of, GCC or a DBC, also very, very range bound. You could even argue they've been range bound for 5 or 6 months, a bigger range, but certainly in the last month or so, breaking lower a little bit. Crude still hovering around the mid 70s, still below 78, but not too far below it. So very, very little decisive action to start 2023.
Yeah, really. And I think probably people will be able to kind of pick this up as we keep going. But to really see any kind of definitive movement anywhere, you really kind of got to go digging around. Like, especially on the commodity front, really the only thing that's moved substantially has been natural gas, and that's been on the downside.
To the downside, I know you mentioned it's coming into a big level going back to a lot of years. This 3, 4, 3, 5. I've seen some polarity really over the last 5, 6 years. Dollar, another asset that continues to not really do anything. And again, big move yesterday. If you want to call that a bullish engulfing, depends on how you want to define that. Some people would. And today gives it all that.
Yeah.
So, what were you saying? I'm sorry.
Well, if you look at DXY, that weekly candle, the way that's forming today, I mean, you can't get much uglier than that, I don't think.
Yeah, and still below a 200-day.
Mhm.
I mean, it is holding on to horizontal support, but yeah, not a great looking candle if you are long the dollar on a weekly basis. But gosh, well, now we're at Friday, right? So we
Yep.
will actually get some. I mean, some of these weekly candles, if you've tuned into them each day, have been quite back and forth, but at least we will get a decisive answer today on how some of these things want to close. And rates, I would put them in the, still kind of bumbling around. They're going to end up red on the week. Bonds are going to end up green. But I don't know if anything has changed.
No, that's kind of been the story of this week, right? I mean, all these individual daily moves kind of really just amount to nothing, window dressing, I guess, really. We're just kind of sitting in these same spots, just kind of waiting to see what'll materialize. I mean, I think kind of what we talked about the most, I think really what's most interesting would be probably bonds, just from the fact that it looks like they maybe, at least in the short term, might be kind of putting in like an established higher low here. Kind of what would that be from basically the end of the last year?
They could be. And I mean, you look at the ag, not bottoming directly where it did in '08, but I mean, there was a lot of action here at 94, 95, kind of late in '08. Not the direct bottom, but I'd put it in the, a level to pay attention to.
Yeah, at least for a week like this, it's kind of something to watch. Yeah, I don't know if
But
it's anything that's
I bet
really
those
right on.
downtrends, I mean, now something like bonds and the downtrends they've been in pretty harsh, right?
Right.
Pratty would probably say, oh, we're super extended from, a moving average. And we were. This is, I think I've got the 200-day pulled up here. And we were a good, 20, 30, 20, high 20s, 20% off at falling 200 days. So is it a snapback bounce? So far, I guess you've got to lean that way. If TLT was able to clear 112, I think that gives you a lot more evidence that puts you back above the 200-day. I'd say 112 is a pretty big horizontal level.
For sure.
But, when you get so far extended from these 200 days, it can create a lot of sideways action until we kind of get back there, which I guess you could say we saw that in something like the S&P. We had the big June bottom. We did get back to that 200-day in August. But you could argue that the entire second half of 2022 was almost working off that drop from, January through June. June, you go sideways. And short term, you take something like the S&P. We talked about this range we've been in. Is it accumulation? Is it distribution? I think that's hard to say. If we're below 3,900 on S&P cash, it's more 3,950-ish on futures. I guess I would lean more towards distribution. Right, we're still in an overall downtrend. We're still in a short-term downtrend, intermediate term, maybe uptrend. If you want to use October as your lows, haven't made a new low. So, a lot of indecision.
Yeah, kind of.
I guess if our sitting here talking about indecision hasn't been obvious enough, you can pull up. You can pull up a majority of charts out there, and Yeah, we left off, and wait, right? We as technicians, it's not like we are expecting some massive behavioral change just because we went from December 31st to January 1st.
Right.
There's, as technicians, there's no difference, and behavior wise, it seems most market participants
Kind of feeling the same way.
kind of feeling the same way. Exactly.
Uh-huh.
Everyone in wait and see move. I mean, there's good, like, and there's still stocks that are doing well. I know you've talked about it, and Prouty brought it up again this morning. I mean, you've got things like Caterpillar moving out to new all-time highs. How bad is the stock market if one of the largest and most important industrial companies in the world is at new all-time highs? Right? So there's that part of the brain that is working, and then there's just the fact that we're in a long-term downtrends and indices cannot seem to break higher. So
Yeah, it's
a lot
definitely
of
slim pickings for sure.
Deer's fallen off. Now you got Deer, right? That was also strong when it's kind of filled its gap back from late November. And the breakouts still, I wouldn't say are working incredibly. We're involved in a couple names. Majority of those just been sitting sideways for, they've got alpha and we're flat on them. They haven't gone anywhere and they're holding up a lot better, but very, very, very limited activity out there.
Yeah, and I think that's a good point too, right? In an environment like this, even kind of some of the breakouts or kind of directive moves we've seen, I mean, they're really not very sticky, right? I mean,
well, and then you take something, so another one where I would put this in the same category as the way Caterpillar looks today would have been Cal-Maine Foods.
Right.
We looked at that.
Was that last
You
week or
brought
two?
it up a
Yeah.
lot and it was good, but then in the back of your mind, you're like, these breakouts. And then you have, and that I would still say that's kind of probably an overall, you're above 53, 52, 53. It's probably still a healthy consolidation. But, these names that hold up well, I would put, previous leaders. I'd put ADM in that list. ADM was a stock that held up really well. It's a great leader, especially on a relative basis until, it's getting hit this. So we'll see. Just still leaders. I wouldn't say the behavior's the greatest, and we still haven't got anything from a price perspective that I think constitutes a breadth thrust. Not that we have to get that, not that we have to have, back-to-back 90% days to signal some, all clear sign, but it certainly would help. New highs versus new lows, not doing a ton. Then again, I can point to some breadth indicators that are improving. I think it was David Cox this morning that had a couple charts on percentage of stocks above the 200-day in the NASDAQ composite. And that had a nice bullish divergence over the last few months. So, again, if you needed any more evidence of the indecision in this market, there's a lot going around.
And I think too, especially when you get this time of year, right around like Christmas, New Year's, people on holiday breaks. I mean, generally you're kind of expecting lower volume anyway during this time, right? So
You are, yeah.
So I mean, I don't think that's necessarily.
I didn't think it was going to be this boring.
Right? No kidding. I know. We basically could have went on a 2-week vacation and
3 week, yeah.
had some fun.
Taking an early Christmas vacation, come back late.
Exactly.
Nothing would have changed.
I'll have to remember that for next year.
Well, I know. Why don't they ever tell you this on the first day? You always get 2 weeks into it, and then you're like, "Why haven't I been sitting on a beach somewhere for 2 weeks?"
Exactly. That's the way it goes, right?
Yeah, I would say the Dow. If we're talking about broad indices, Dow still looks the best, and that makes sense when you look at our growth value relationships. Value's still absolutely the outperformer. fact, I think tech hitting new or new relative lows yesterday. They're getting a bounce today because it's the way this market seems to work. But yeah, tech. And then financials, new relative highs, getting back up there, new relative highs, depending on what ETF were there on its relative highs on an absolute basis. They are above their 200-day. I'd probably want to see like 36 on something like XLF.
Yeah, if not
We're at
37.
35 at this point. So I'd wait. And then industrials, materials, two other sectors making new relative highs. Industrials on an absolute basis, I'd kind of put it, not surprisingly, looks a little bit like the Dow. Materials, I mean, these just really aren't things that I'm buying on an absolute basis, just, I guess. Still
No.
in these, are these just going to be your outperformers during a third leg down in the majors? Haven't quite put my finger on that one yet.
No, and
I
that's
don't think we have. I don't think we have to either.
That's like too, when you look at like a lot of these relative charts, like even just broad value growth, if you do like mega cap value growth, MGB, MGK, I mean, that's kind of, we're basically at an area, especially if you look at the candle today, where you would expect resistance in that relationship.
Yeah.
You kind of see it other places too, like Dow to the S&P is kind of in the same boat.
A little divergy there on the RSI and
So,
MACD.
Yeah,
that's growth value, or value versus growth, has had a very strong 2022. You're very right. We are, but then it's been so bad for a decade that we're just making up for lost time.
right. Yeah, definitely be the case.
And energy continues to hold up well. That fits the value thesis. Financials, I would argue, has been a little bit more of the insurance. I mean, banks.
Yeah, insurances look good for a while.
Banks are okay. I mean, the big bank, I'm buying Bank of America here, probably not. Sorry, Dad. One day. JP Morgan, a little better. Regionals.
But even when you bring up insurance, look at something like IAK to the S&P.
Yeah. Look at that. Look at insurance on an absolute basis. It's not horrible.
No, but then if you start looking back far enough on some of these things, like I'm still looking at insurance to the S&P. You essentially are trading in a range since after the financial crisis until what is this?
Yeah.
Kind of the end of 2019. Sharp move downward. You're just kind of reclaiming.
Now we're
into the center of that range. So, is it something where, kind of like you were saying, right? They've been getting kind of kicked around for so long, essentially just kind of clawing their way back, and
then you wonder, right? And when you look at those, right, you look at the last 10, 15 years of price history, and a lot of these places got their butts kicked, like you said, on a relative basis, and they've had sharp moves over the last 12, 18 months. But then, okay, so let's move forward the next 10, 15 years. It's just, is this just it's not that big of a move when we think about it in that context of, okay,
right.
Well, maybe we're getting started on the next, right? And we know that's been I would say it's a pretty well held thesis that the next bull market, when it does arrive, whether that's now and stocks did bottom in October or whenever it is probably going to be led by value. Typically, that's how cycles work, right? We had the 90s where the dot-com growth, internet, things like that. Then we move in, so dot-com crashes, we move into value, right? 03, 08. Banks, industrials, commodities, foreign stocks, all the way. No one wanted anything to do with the dot-com stuff, the previously sexy stuff. Regional banks were all of a sudden hot. And then those all got walloped in 08, 09. So we moved back to growth, where I'd say we've been probably since 2016, 2017. If you pull up like SPYG versus SPYV. I would say that's been kind of where a lot of this
Mhm.
got going.
Well, yeah, funny enough, you mentioned, like foreign markets there too. I mean, really, when you start looking at current time period now, really the only kind of areas you're seeing a little bit of life, it kind of seems to be more some of those international markets. Like, China's one we've been talking about
China,
this week quite a
China, and Europe. I mean, Europe, just especially on a relative basis, they've been strong for a while. I think a lot of that goes back to, I mean, how are all these foreign indices, countries weighted? When we look at their actual home index, like their version of the S&P, and then we look at the ETFs that are here, and they have always been substantially higher in value stocks, mainly financials and healthcare. And look at the outperformance they've had. So yet again, another piece of evidence that growth has just been such a massive headwind.
Mhm.
And okay, so you look at something like the DAX. I mean, the DAX. You look at the DAX, not EWG, the American ETF representing German stocks, with the actual DAX index. I mean, you get above 14,700.
Yeah.
Now we got a neckline up there of 14,900, I guess. Which wouldn't that just be like the market to run it up there and then fail to break out? But absolutely, I mean, it's got to be one of the best indices in the world right now. It's got to be stronger than the Dow.
Oh, I bet.
Yeah.
Let's find out.
Yeah, over the last few months, certainly.
Yeah, it's actually not how I expected it.
No, and I expected
look,
either, but it has outperformed
Mhm.
by 10%, but the underperformance has been so bad for so long. So it's outperformed by 10% since August, but that basically brings you back to where it was in June as
Right.
far as relative performance. So kind of a microcosm of what we see a lot. Staples, another one I would say that's holding up a little too well for my liking. Again, not that Staples can't be a market leader. And there's been obviously a lot of hype over the dividend names and Staples, it's mainly value. But that's certainly a relationship I would like to see break down to kind of be able to put that back in the bullish evidence bucket. Because right now I'm keeping that in the bearish evidence bucket.
Yeah, I mean, XLP to the S&P, at least here in short term, right? I mean, that's pretty clean breakout holding so far. It's hard to argue with that.
All right, I got one. I'm a little nervous to bring this up.
Boy.
Because I know
I already know where you're
everyone's feelings. But they have been strong lately. I'm just saying, I don't pick the price chart. It just is what it is, Kevin. I'm just saying. Gold miners and silver miners.
Yeah, they look good.
I'm not saying it's been the prettiest trend. Arguably a little bit more behaved, though, than some other things in this market.
Yeah, which is a low bar.
Higher.
Yeah.
Gold miners are above a 200-day. It is still, I'm going to put that in the downward sloping 200-day category. So it's not like we've got the full, tailwind of momentum behind us. Silver miners up there. Gold itself, I mean, not bad. Copper miners, also another area that now copper below, on an absolute basis, copper below $4, have a hard time. We're sitting at 3.9 now, so we'll see.
Yeah, and actually, they're talking metals, like platinum, palladium. Palladium really hasn't looked good for a while, but at least it's like if you use futures, kind of holding that 1650-ish where you'd expect support, so it really hasn't necessarily broken down further. And then platinum really in the last week or two hasn't looked bad at all either.
Strong. We had that for a few days. Took the wind. It's having a nice
Nice day today.
Nice today, kind of back up to where we sold it. Yeah, so we'll see. I mean, again, is this last 3 weeks? Has it been accumulation? I got some evidence that says has it been distribution? I got some evidence that says also So, I mean, lucky for us, we can sit for the most part and kind of just
Wait it
wait
out.
and see.
Mhm.
The ETF continues to sit in T-bills. It is not kicked long. This should be not a surprise to anyone, as we have not really reached those signals yet. So we muddle around.
Mhm. Yeah, really, I think that is probably one thing that's easy to take for granted, right? I think, especially kind of the way we operate here, the ability to not do anything is at times like this pretty nice, right? I mean, some people aren't that fortunate, if you have different mandates and things like that.
Yes.
It's not the most exciting thing in the world, which I'm sure people can figure out, considering that we've wanted to be on vacation probably for the last couple weeks, month and a half.
I mean, we're in 90, if you include T-bills, 92%. I mean, we're basically, marking it. It's just, hey, we're hanging out
Yep.
until someone decides to do something.
Sitting around the water cooler.
Playing cards.
Yeah, that's about it.
And like we were saying earlier, I mean, you get these days where it's like, okay, is this the start of something? Even have those thoughts on days like today, but neither side can put in really a trend. And we have these big, how many of these gap opens, whether they've been up or down and they get faded. Or you gap and that's basically the highs of the day, and then the next day they're faded. So a bunch of nothingness from our perspective. I'm sure there's lots of people, maybe for their process, there's lots going on. If you're a short-term range trader, you are probably loving this.
Right. Either that, or if you're trading some of these other markets like in China, or even like if you kind of peek through some individual stocks and like Mexico, or here's Latin America. I mean, you can, I'm sure there's plenty to participate in there. But that's the thing. If you're stuck to some of those more broad, like index ETFs, things like that, really you're just kind of stuck here waiting to see which way we're going.
Or especially if that's your benchmark.
And
you have things, right? Semiconductors, 4% today. Guess they look okay. Does it change my opinion on anything? No. Is it fixed anything? No. Could it be the start of something new? I guess. It'd be 2 days into it, so it's a little.
Yeah, it's just too early to tell. You can almost.
It really is, and let's start getting. And again, we're not moving average people per se. We are not sitting in here tinkering around with moving averages and deciding whether we should buy and sell things on, when we have an individual but if we use something like the 200-day, which the ETF does, strictly not for individual positions, just whether, in and out switch. Let's start getting above about that. The Dow is there. We've got one of the 4 major indices is there. Has held above it this entire range, right? Dow's been in the same range as all the other indices since middle of December. We'll see.
Yeah, you're kind of just seeing glimpses, right? Which I guess we've been saying for how long now, right? And especially with bonds, like at least personally, that was when we would talk about what we want to see to kind of start gearing up for a move higher. You want to see some life out bonds, which maybe you're seeing that now, but it's just too early to really tell. If you're going to act on it, you're essentially guessing at this point.
Yeah.
But it gives you hope.
We would like to see some assets go up. I think, in fact, right before you had shared or Dave had shared a chart, so 2022 year over year, everything was down, basically except for, this says MLPs, but we'll use energy stocks in general and commodities. And so much of that commodities was the first quarter. I mean, if you were jumping on, yeah, so I mean, commodities ended up, you want to look at something like GCC, they were up on the year. But unless you had been involved in January and March,
Yeah, I think you missed it.
yeah, I mean, I don't,
Or you're probably actually worse off depending on where you're positioned there for it.
yeah. You look at DBC, yeah, you're up 10%, 10, 15% in the year. But after June, you're down 22.
Mhm.
So, and that's how markets are. I mean, right? We look at these year to date numbers, but how much of that occurred, in what time span were you able to take advantage of it? A lot different than saying, oh, we should just own MLPs and commodities all year
Mhm.
and cash. How about that? Cash actually positive because you get something on it now. And that'll be a new, I think cash becomes a much more of a legit asset
Mhm.
over the next year if we go into a rising rate environment. I mean, the thought of being able to sit in cash and collect 3, 4, 5% will become very, very attractive, especially if we get to 2024, major indices still really haven't gone anywhere. And this is starting to look like it's going to be more of a 1970s, like we're just going to bumble around for a decade.
Mhm.
Yeah, cash. And again, and those cash, probably bonds. Well, these cash flow producing stocks like dividend
Mhm.
stocks, yeah, probably gonna do pretty well.
Yeah, 'cause I mean, that's the thing, right? How long has it been since there's been a real true like hurdle rate to where, I
Mhm.
mean, really it's just been understood,
Not in my
right?
career.
Yeah, I mean,
I mean, money
stocks were
markets
just
were there, but you never
you didn't expect
considered
anything from
them
them.
as like an actual. You consider them as an asset as far as exposure.
Yeah, like a risk management tool,
Yeah,
essentially.
exactly. That's a
Yeah.
great way to put it. A risk
Mhm.
management tool, but not as like, hey, I could actually hold like 10 to 15% of this in my portfolio for the whole year and collect 6%.
Yeah, your CDs coming up a lot more now again, which like,
Mhm.
man, I think I was still probably pretty young when CDs really you would hear anybody talk about them, and now
Now I
kind of
have
making
it.
their way
And
back. Yeah.
just when I was with my parents every Christmas, they were telling me how they had gotten a CD at some small community bank there, like a 1-year CD. Yeah, I mean, we've already been through 2 years of nothing really on the major indices.
Mhm. Yeah, and that's the thing. Until you get, I mean, solid direction and something. I mean, it's just
I mean, we're sitting
there's
where
no
we
one.
were February, mid-January, early February 2021. We're coming up on 2 years here at, sitting around 38.50.
And I can't tell if it feels like it shouldn't be that long yet, or if it feels like it's been longer. Some days I almost think a little bit of both.
Yeah, no, I absolutely, man, February 2021. That was 2 years ago.
Mm-hmm.
That's basically when stock, we know that's when the average stock stopped going up. February 2021. Russell 2000 hasn't moved. Russell 2000, the same spot it was at September 2018. So,
They can't sum it up any better than that, right?
gone a lot of places in between. We had
Mm-hmm.
We had the Christmas Eve 2018. We had COVID. We had the post-COVID face ripper. And now we're just kind of neutral.
Mm-hmm. Yeah, I'll tell you what, just obviously I've not been involved necessarily in this industry very long, right? But I mean, I think going through a time period like this, kind of so early, I think in my career, it's definitely interesting, right? And definitely highlights kind of how you can get caught up in kind of some of these daily moves, especially in ranges like this, right? And when you take a step back, kind of go on a weekly, monthly basis, and I mean, you just finally realize you literally have gone nowhere for how long.
Yeah.
And
No, I
it's an
agree. And
interesting
I
time.
think when you enter the industry has such a big impact on how you view the market.
Yeah, 100%.
I mean, I think and I like, I'm aware of it. Like, I have a massive, I don't know if I would call it a bias. I'm just aware of the environment that my career like has spanned. It has been, for the most part, by the day. Whereas imagine if you spent your first decade in this industry was the 70s. You'd be like, well, stocks don't do crap. Like, stocks just go up 20% and then they're down 20% the next year and they don't do anything. And yeah, I mean, I haven't really seen a ton of, and in the long term, I don't really think we're in a sideways environment yet. Not like anything like the 70s. I mean, are we sitting here talking about, Russell's in the same spot it was a few years ago? Yeah, but this is not.
It's not to that extreme yet.
It's not that extreme where you literally get into a decade of up 20, down 30, up 20, down 30, and your retirement hasn't moved for 12 to 14 years. Markets haven't moved. Indices, again, it's a better way to put it. I mean, 68 to 82, nothing. I mean, a lot of places, but really overall nothing. And then how about that? 82, Kevin, what we were just talking about, 82.
Yeah.
Before we hopped on here.
Yep.
So you had probably thrown in the towel. 14 years, stocks hadn't done anything on a grand scale. Bonds are probably getting crushed because rates are going up all through the 70s. And then 82, you have the best year ever for stocks and bonds combined. And you're kind of off to the races for about close to 2 decades.
Right.
And the same thing for, 2000 through 2013. Lots of interesting takeaways based on perspectives of what you have witnessed and experienced. That's why I understand why old men in the industry are so grumpy. I don't blame them.
No. I mean, that's the thing. You look at the 70s.
When I hear someone has like 30 or 40 years experience, I'm like, oh, that guy.
Yeah.
All right. Was there anything else you want to leave our listeners with before we get back to doing our day jobs here? Hopping on this market call in a few minutes.
No, I don't think so. I mean, you just got to wait and see, right? And that's basically where we're at, where we're done.
Yeah, wait.
Not much more you can do.
Where our leaders for 2023 take us. Right, last year I'd put, of course, energy in that bucket. Energy, if we go back and look, I'm not saying this has to happen. I'm not saying that leaders have to expose themselves on the first day of the year. We do go back to early January 2022. Energy definitely quickly moving in the opposite way of the broad markets. You kind of had a breakout there early January, the 4th, 5th. I mean, it's definitely that first week. If you go back to the first week of January on the S&P, I mean, you're definitely, there's that first couple weeks, you can see some separation there in energy stocks and the broad market.
Yeah, and I didn't look back.
No. And so are you getting that here with China? Are you getting it with gold miners? Maybe. Are we going to be sitting here in March saying, wow, S&P is down another 10% and gold miners are up 15?
That's the thing. I wouldn't be shocked if in a couple of weeks, this episode's out the window, and I mean, you just see some of these areas just be gone. I mean, it wouldn't surprise me one bit if
they're holding up.
Yeah.
I mean, China, big moves, haven't slowed it off yet. It's above a 200-day. Certainly a relative leader. Intermediate term relative leader, longer term, not maybe too much different than these runs it's had on a relative basis over the last few years. All righty. Well, I don't really have too much either. So we will wish everyone a great weekend, and we are looking
Mhm.
forward to navigating this market with you in 2023.
Yeah, for another year.
It'll be very different, or probably very similar, yet very different than all the others.
Mm-hmm.
All right, have a great weekend, everyone.
Yep, have a good weekend.